When you were in school, you learned how to calculate the area of a rectangle, but not how to invest your money. And now you hear how people are making money by investing. You ask yourself, is it really as easy as people say? You don't even know how to buy stock in the first place. You know, to become seriously rich, you need some sort of passive income. But how? You have $100 in your pocket and wonder how you can turn it into $1,000, $10,000, or even $100,000. Because of this lack of knowledge, it seems pretty scary for you to get started in investing. In this video, we will solve your problem. Hi money makers, welcome back to our channel. This video is significantly important for people who have money but don't know how to invest it. Before we start, hit the bell icon and subscribe to our channel if you are not a subscriber. Let's begin. Our elders taught us from childhood that saving is the easiest way to make money, but this is not true. Of course, saving is a key factor in making money, but there is a more important factor that plays a key role in making money. That is an investment. Think about the fear that stops you from investing. Actually, you are scared of financial loss as opposed to financial gain. When you work hard and are disciplined enough to cut consumption and save, the idea of losing your hard-earned dollars makes you uncomfortable. Eventually, you deposit your money in a savings account to earn an insured profit. This is a mistake. The money you put into a savings account is almost guaranteed to lose its value. The reason is clear. Savings accounts offer low interest rates that can't keep pace with inflation, meaning that your money's purchasing power decreases as long as you put it in the savings account. At the next step, you should ask yourself how much you need to save to invest. Considering every individual's unique condition, you should save as much as possible. Put it simply, and try to save 20% of your income. Start investing as early as possible. Invest when you are young if you want to see solid returns on your money. You wonder if it's possible to get started with a small amount, like $50. Fortunately, now investing with a small amount is possible more than ever thanks to low investment minimums, zero commissions, and fractional shares. Now, a question comes to your mind. Where and how can I invest my money? To address this question, we will describe methods for investing your money. However, we will focus more on the stock market than other markets because it dominates other markets. Let's break it down. Investment in the stock market. When you imagine investing in the stock market, the first question that comes to mind is about shares and the stock market. What are shares and stock markets? To understand shares, suppose you are the sole owner of your business, but you want to increase your business, and for this purpose, you have to open more branches and hire more employees that need more money. To attract investors, you offer to sell them a share of your business. For example, you offer to sell them 10% of your ownership in exchange for money upfront. The shares in the stock market show your ownership of a company. If you have 5% shares of a company, you are the owner of 5%. On one hand, many business owners want to sell a part of their ownership to get money. On the other hand, many investors want to buy a share of ownership in a business and expect growth in the business in the future. The sellers of ownership can sell it through two methods. First, they can sell it privately. Second, they can sell it publicly. In the second case, the concept of the stock market emerges, which is a market where everyone can buy ownership of any company. How does investment work in the stock market? Understanding the mechanism of the stock market is very easy. Every buyer in the stock market wants to gain more and more profit. He keeps a close eye on every company, including its management, products, reputation, and other aspects that impact its income. For example, a new company is listed on the market and sells its shares. One share costs $10. Considering its performance, investors feel that the ownership of this company will lead to profit. If they buy a share that costs $10, now they can generate income by selling it for $30 after 1 or 2 years. The simple rule of supply and demand works here when investors decide to buy the shares. As demand for the share goes up, the supply goes down. Investors who buy as early as possible gain more profit. There are various stock markets all over the world. A new company offers its shares in an event called an initial public offering and chooses a stock market where its shares are sold. Thanks to the internet, you can buy shares online. You can register yourself at a trading website and browse all the stocks available on any stock market. Investment in the index fund. To understand index funds, suppose there is a machine in a factory that puts the most popular chocolates in a bag. You can pick any of them and enjoy your favorite chocolates without having to pick and buy them separately from the market. Now, think of well-known companies whose shares are collected in one place called an index fund. In other words, when you buy shares of an index fund, you own stock in dozens, hundreds, or even thousands of different companies. S&P 500 is a real example of an index fund that consists of the 500 largest US companies and offers the opportunity to invest in New York stock. If we compare investments in an index fund with investment in individual stocks, index fund investing is better because of its lower cost. Additionally, you do not need to keep an eye on the company's reports and reputation. Investment in a mutual fund. A mutual fund is similar to an index fund in terms of the diversification of stocks, but they are different in the listing of the companies. For example, the S&P 500 index fund has a specific list of companies that you cannot change, while mutual funds can change their lists. Index funds do not need human oversight on buying and selling, meaning that their shares value track an index at a specific stock exchange. The values of shares in index funds follows the prices of individual stocks of any company. But mutual funds are managed by their managers, who make all the investment decisions. They can change their stocks depending on the performance of the company. Thank you for watching this video. We are waiting for your feedback in the comments. Hit the thumbs up and share this video with your family and friends. Goodbye, and we'll see you in the next one.